Hey everyone, welcome back to the channel, your number one source for income-oriented investing. I got a very special guest for you today, Dean Rico, CEO of Middlefield. How are you, Dean?
I'm great. How are you?
Ex- I'm good. I'm excellent. Just back from New York, like we discussed. So I'm energized and back to business here. So thanks very much for taking the time. This was very, very impromptu. This is not a sponsored video or anything like that. You're basically just taking time out of your day to discuss the RA.UN closed-end fund merger with the RS split fund. So I'm talking to my audience here in case you didn't know, and I'm just going to share my screen real quick here. Middlefield has a closed-end fund called RA.UN, which is the Middlefield Global Real Asset Fund, which is about a little over 70% REITs and real estate. There's some pipelines and utilities, but they basically announced their intention, or to put it to a vote, to merge this fund with RS, the Real Estate Split Corp. So the press release is here. I'm going to put the link in the video description below. So Dean, let's just start with why you guys decided to do this, because it kind of reminds me of what you did with CLP.UN. You recently merged that one. Well, not really merged, but you transformed it into a split fund. So you're kind of doing the same thing, but with an existing split fund. So why did you guys decide to do this?
Well, first of all, thanks for having me on, Adrian. I'm always happy to
Pleasure.
speak with you and provide some clarity on what we're doing with our funds or on the market generally. So, in respect of RA, this was a fund we launched a few years ago, and it was a relatively small fund. And over time, we've decided some of these smaller funds are just difficult to get any real liquidity in them. And on the other hand, you've got something like RS, which has really grown very nicely over time. So from the perspective of an RA unit holder,
Yeah.
we thought it made good sense to merge it into RS, where you got much better liquidity within the RS shares. You get the opportunity to kind of participate in this split share structure that RS has, which I think is really quite unique. So you get that preferred share, you get the Class A. And then from the perspective of RS, what you also are getting is just greater liquidity. So it's going to grow the size of RS, which
Yeah.
again results in greater liquidity. Plus, it also results in the cost of running the fund being spread over a larger number of units, which reduces the cost per unit as well for RS investors. So I think it really is a win-win in that it gives the RA investors the opportunity to participate in a larger fund and the RS investors to get a larger fund and reduce their cost per share.
Excellent. I like when I hear win-win. So, as an RS investor, like myself included, you don't have to do anything, right? This is just more assets, another fund coming in. What if you're an RA unit holder? Like I read in the press release, you will get, correct me if I'm wrong here, maybe I misunderstood it, one share of preferred, one share of Class A, and then at the further down, I read based on the value. So if you're an RA.UN unit holder, let's say you have $10,000 worth of RA.UN,
Yeah.
how will that translate? What will be in your account if the transaction goes through? Will it be $10,000 worth of RS split between preferred shares and Class A shares? How will that happen?
Yeah, so you do get that split of prefs and Class A coming out of RA and going into RS. I know we're throwing a lot of acronyms around, so
Yeah.
hopefully you can
My
follow.
audience knows. My audience knows generally
There's
split funds how it works.
Yeah,
So yeah,
they understand how it works. So, and then you get them in a pro rata amount. So basically, is the NAV of RA being
yeah.
swapped in for that combined NAV of RS.
Okay,
So you're going to get it on a NAV to NAV basis. So and then split between what the NAV of the pref is and what the NAV of the Class A is on a pro rata basis.
okay, makes sense. Makes sense. So now let's discuss because I did see some very interesting things about RA. The thing that intrigued me the most by far is this guy right here. So RA is like I mentioned before, mostly real estate, and a lot of these REITs they're in RS. You guys, like we talked about many times, you have a high conviction portfolio of 10 to 15 REITs, which are like core, like Granite and Boardwalk and REIT and things like Choice, Minto. But this one here, the Blackstone Core Plus Real Estate LP, 37% of RA. In the press release, it said, you know, if we would do this now, RS will actually gain some exposure to this, about 5.7% or something like that. So will the composition of RS, if and when happens, will change? Will it have any of the pipelines and energy, or will it just stick with REITs and real estate, but we'll start getting a little bit of exposure to this Blackstone Core Plus thing?
So the short answer to your question is that RS will continue to be a real estate fund. So you're not
Okay.
getting any exposure to pipelines or any of the other type of infrastructure plays that RA has owned historically. But because you're getting all real estate, you are also getting this investment that RA has in the Blackstone Core Plus North American real estate portfolio. So just to take it a few steps back, when we launched RA, one of the unique features that attracted investors into RA was that we were going to give them exposure to a private fund managed by one of the leading real estate investors globally, Blackstone.
Blackstone, yeah.
And we track this fund on a regular basis. We get quarterly reports as to what the composition of the portfolio is. And it really is a high quality portfolio comprised primarily of industrial real estate, multifamily real estate. It has some life science real estate as well. Doesn't have any office, or it's really taking that office weighting down. And for Canadian investors, they may also be familiar with Pure Industrial REIT, which Blackstone acquired about 6 years ago. I think the deal was done in 2018. Pure Industrial was a publicly listed industrial REIT, listed on the Toronto Stock Exchange, primarily with assets in Canada, some in the US. And Blackstone acquired that, took it private, and then a lot of those assets ended up in this fund. And those are high quality assets. We were one of the largest shareholders of Pure Industrial REIT. We loved the composition of that portfolio. We've now got an opportunity to own those same assets again because they're actually held within that Blackstone portfolio. So I think net, this is a real benefit to RS investors because they're getting exposure to this portfolio, and it's a relatively small amount. As you said, it's about 5% of the fund on a post-merger basis, but
Yeah.
it is a unique asset that average investors just can't get access to because it's primarily reserved for institutional investors like our funds.
Yeah, I was just gonna ask you about that. So if my first question on this is private. This is not something, it's not listed publicly. It's not something retail investors could get access to. Is it mostly Canadian REITs in this Blackstone Core Plus or mostly US exposure? That's my
It's
first question.
got mostly US, but
Okay.
it's got a lot of Canadian exposure, primarily in the industrial part of the
Okay.
real estate market. And as I say, that's mostly in that original pure industrial portfolio that Blackstone acquired about 6 years ago.
Okay, so considering RS is 100% real estate, 95% here almost in Canada, you're gonna get a post-merger a little bit more exposure in the US. So I would say that's even more diversification,
Correct.
even better for RS, more diversification. And like you mentioned, there's no or barely any office REITs in there, just like in RS has no office stuff, right?
Correct. Correct.
That's perfect. That's perfect. So I'm very excited about it because I have a humongous position in RS personally. I think it's one of the most undervalued, by far the most undervalued sector in the market right now is REITs. And this is the last thing I want to discuss with you because I can't think of anyone better to talk to than you on this because this is your firm's core competency for decades and decades. So would you say that REITs right now, excluding office, because office is really, really having a bad time for obvious reasons. But if you look at RS, it's mostly very high quality industrial, apartment, retail, REITs. Would you say that it's the discounts on REITs or the undervalued in terms of percentage? Is it the best in the last the most undervalued it's been in the last 2 years, 5 years, or since the 2008? Like, what is your feeling on how undervalued and AKA a great opportunity it is right now in terms of the past?
It's a great question. Let me say a few things. One, like you, I have a very large personal position in RS, so it's a major holding for me and my family. Just shows you how convicted I am on its portfolio and the sector generally. Now, in response to the opportunity today relative to what we've seen over the last 20 or 25 years,
Yeah,
'cause I've been managing REIT portfolios really since they came into being in Canada in the mid 90s. So I've seen a lot of cycles. And I would say the average discount that you're getting in the Canadian REIT market today is, somewhere in that 20 to 25% range. Some people have it a little bit higher, depending on what your NAV estimates are. Um, and, we've seen this type of discount through previous troughs in the REIT market. So, you highlighted 2008, the global financial crisis. We saw those types of discounts. And then you also saw it during the pandemic. But I would say in each one of those prior discount periods, the discount didn't last as long as it's lasting today. And in fairness, we've seen the biggest move in interest rates in a relatively short period of
yeah,
time that we've seen, really since the 1980s. So the market is digesting that move in rates, and it's been our view for the last 6 months, and admittedly, we were early on this call, that rates would eventually start coming down. So you've seen the Bank of Canada cut once, and we think those cuts will continue in the latter half of this year, probably get at least another two cuts. And I think you're also going to get a few cuts in the US. So taking a step back, you've got a sector with a very significant discount to NAV, where the fundamentals, as you highlighted, outside of office, continue to be as strong as I've seen them in years. And we're waiting for some catalyst events that will really drive this increase in price closer to NAV. So to give you some perspective, we've recently done some work where we looked at Canadian REITs over the past 20 years, and on average, they've traded at about NAV over that period, relative to this 20 or 30% discount to NAV. And we've looked at them when discounts were at 10% or discounts were at 20%. The recovery in market prices
yeah,
in periods after discounts like that, is in that 20 to 40% range. I'm not saying that's what's going to happen here, but that's the opportunity that you've seen historically
right.
when you see discounts this deep. So a long-winded way to answer your question, Adriano, I think the opportunity is really very good. I think as long as we don't end up in a deep, hard landing type of recession, I think you're going to see a significant recovery in trading prices over the next 6 to 12 months, because the fundamentals are extremely solid, whether it's industrial, whether it's open air, grocery anchored retail, whether it's multifamily, or even seniors housing. That's another sector that we like, and you've got exposure to that in RS through companies like Chartwell
Yeah.
and Sienna, where the fundamentals continue to be very good. So bottom line is, I think this is an excellent opportunity for investors looking for exposure to the REIT market.
Yeah, and when you're talking about that was perfect, Dean. Thanks for that. When you say 20 to 30% discounts on some of these REITs, we're talking about the quality REITs in RS like Boardwalk, Granite, Dream, CapREIT, RioCan, Choice. I mean, to have 20 to 30% discount on those quality REITs seems very exaggerated to me. Almost like there's so much FUD in the market right now, fear, uncertainty, and doubt, that now is a fantastic time to get in. And like you said, what I also registered is that you said normally they trade at NAV, which means the stock price is close to the NAV. But now you're saying there's 20 to 30% discounts. This is on quality what I call blue chip REITs. So thanks for that, Dean. I appreciate you sharing that you own RS as well. I do too, a large chunk, and I'm gonna keep buying it. I've been buying it every month. I've been suggesting that. Hold on a second. This is exaggerated. This sell off is exaggerated here. It seems like, but also RS is leverage, right? If you're looking at the Class A shares, so let's say it does recover 20-30%. That's going to be leverage. It's going to be even higher.
Yeah,
And one last quick thing I will share with my audience is that even the net asset value of RS, the premium, it was trading at a fairly big premium, but now it's also narrowing. I've been noticing that every day it's narrowing a little bit, a little bit. Now it's under 15% premium, whereas it was over 20 at one point. So I think it's a fantastic pickup. And I'm talking to my audience here in case you're not comfortable with split share funds, you don't understand that much. I do remind you that Middlefield also has a phenomenal ETF, which has no leverage, no split share fund structure, and it's MREL. It's one of the top performing REIT ETFs ever historically. So you could also check that out. And I think the yield on that, with no leverage or anything, no covered calls or anything, correct me if I'm wrong, is hovering near the 8% mark, which is
correct.
absolutely incredible, much higher than a VRE, XRE, ZRE, the more index ones, which are hovering about 5. So just wanted to point that out to my audience in case you're an opportunistic investor, long-term investor, you like real estate and REITs. Now's the perfect time. You have those two options from Middlefield. So Dean, thanks so much for taking the time. I appreciate it. Looking forward to the merger. I like the idea of getting access to that little Blackstone private equity. I mean, Blackstone is synonymous with, real estate empire. So I can't think of anything better than that. So I appreciate it, my friends. Hope to have you on in the future.
Likewise, I'd be
All
happy
right.
to.
Take care. Have a good one.
Thank you.